Next, I'm going to walk you through the extracts from the 2017 budget. So this is the management accounting information we see in these tables on pages 19 and 20. First of all, we have the vehicle sales budget for 2017. As we know, Ashworth Lea is a company that produces 3 models of car. This is the Regent, the Regal and the Royale. And here we have the selling price per car. And it's difficult to know what the exchange rate is for the dollar, impossible in fact, but if it's close to the regular dollar or Great British pounds or something, we can see that these are very high-end vehicles with a high retail price. 183,000 for the Regent, 225,000 for the Regal and 200,000 for the Royale. So the Regal is the largest model. It has 4 seats and 4 doors. The Regent is the smallest model. That's the one that actually has been suffering from declining sales in the last year. And the number of car units they're going to sell, or that they expect to sell in 2017, is listed here, with 1,500 cars anticipated for the Regent model, 2,000 budgeted for the Regal model, and Royale being the highest seller at 2,500 units. So that gives us a figure of 6,000 units. So really small compared to the mass manufacturers like Toyota that produce 17 million cars per year. So multiplying then the number of car units by their selling prices, we get these total sales figures and gives us total revenues projected for 2017 of 1.2 billion. And I would ask the question whether that's ambitious enough for the company, because it represents just a 2.4% increase on 2016 revenues. And in fact, it's below the 2015 revenues. So is it ambitious enough? I don't think it is. And then I would ask also, who's setting these budget figures? Is everyone involved in the production of these budget figures? Or is it just finance people? If everyone is involved, and let's say salespeople are involved in setting some of these targets, it would be in their interest perhaps to set low sales targets that they could easily surpass, and then they would get higher commissions for achieving and exceeding their targets. So that's just something maybe to bear in mind. When you look then at the per unit costs of producing each of these cars, the standard costs going into the production of each vehicle, it's interesting. The material cost is undoubtedly the biggest cost across the board for all 3 models. So you'll see that the material cost of producing a Regent is 68,000, while it's 110,000 for the biggest model, the Regal. Makes sense. There's more material going into that unit, and 85,000 then for the Royale. So the material cost seems to correspond to the size of the different models. The labour costs then are running at 17,200 for the Regent, 14,700 for the Regal and 18,000 for the Royale. Interesting that the Regal has got fewer labour hours going into it, and you wonder why that might be. Production overheads then, let's see how they're assigned. It seems they're assigned on the basis of labour hours, so that they're running at 34,400 for the Regent, 29,400 for the Regal and 36,000 for the Royale. So we can see then the percentage split between total costs per model. We'll see that for the Regent, 57% of the total costs of producing the Regent go into the materials. 71% of the total costs of producing the Regal relate to their material costs, and while 61% relates to the total production cost of producing the Royale relating to material costs. So we'll see then also the total material cost adding up the 68,000 for the Regent, this 110,000 for the Regal and the 85,000 for the Royale, leads to total material costs for all 3 units of 263,000. 49,900 total for the labour costs going into each of those models added up, and 99,800 going into the production overheads. And the way those production overheads are assigned, as you will see, is by labour hour. You'll see that the production overheads, for example, represent 34% of the total production overhead costs, while the labour costs for the Regent represent 34% also of the total labour costs. So that's the way they're being assigned. I asked the question whether maybe too much production overhead is being assigned to the Regent based on the labour hours, and if that's the case, then the total costs of producing the Regent are being inflated, which means that the sales price needs to be kept high to keep those margins, those gross profit margins, high too, in which case it might explain why sales have been faltering and declining for the Regent model recently. So it's just something to bear in mind. When we look at the gross profit margins for each of these models, you see that they're quite healthy. 35% gross profit margin for the Regent, 32% for the Regal, 31% for the Royal. And when you think then of the total contributed gross profit, multiplying the standard gross profit by the number of car units and that they're budgeting to sell for the year, this is the total contributed budget profit per model: 95.1 million, 141.8 million and 152.5 million for the Royal. So the Royal is the model that's contributing the highest overall gross profit amount to the company's gross profit figure. Then we come to the self-drive cars. So it seems that Ashworth Lea is just going for it. They're going ahead with it in 2017. They're anticipating that they're going to produce 45 units, very, very low amount. And what's interesting in this section is the sales price, first of all, which is 100,000. That's significantly lower than their standard, their three major models. And I would ask the question of whether they're looking to move towards the mainstream with these cars. So you would question, if they're doing that, is it a wise move? They're in danger maybe of diluting the prestige of this brand. Okay, I'm reminded of the real life example of Tesla. Tesla is soon to release a mass market Model 3, which will be priced much lower than their other models. Tesla is quite a high-end electric car, and to date their models have gone for prices towards $100,000, a little bit lower, maybe $70,000, $80,000. And with the mass market Model 3 that's going to be released in the coming months, I believe, they're talking about a sales price of $35,000, $40,000, making it much more accessible to the general buying public. And Tesla's staking its future on this. They have said publicly that this is what's going to guarantee its sustainability in the future, getting the mass market model and selling plenty of those. I question whether it's a wise tactic for Ashworth Lea. Ashworth Lea is not Tesla. It's got really, really premium car models, as we saw on the previous page, going for $180,000, $225,000. And I'm wondering how they would transition to being a mass market producer. At the moment, of course, we're only talking about 45 units. This is a test phase for Ashworth Lea to see what the public response is to these self-drive cars. The profit margins are also noticeably lower. Profits of 10%, gross profit margins of 10% for these particular models, the self-drive cars. Reflecting then on the information we've been given in the management accounting figures, I would first ask whether the sales targets being set for 2017 are ambitious enough or not. Up just 2.6% on the 2016 figures, which were disappointing, remember, and below the 2015 figures. Could they not be more ambitious setting revenue projections? The overheads are being assigned on the basis of labour hours, and I would wonder whether it's accurate for the region model in particular. It could be resulting in an artificially high allocation of costs and an artificially high price, and results maybe in the demand being affected as they've seen recently. And then the move, of course, towards the mainstream is being hinted at, with the lower price being charged for the self-driving model, and as a result they're accepting a lower gross profit margin of just 10% for this particular model.